So essentially, when we think about building an LBO model, then we come up with the purchase price. Again, we look at
Yeah.
it's a public company. We put a 25-30% premium on it because that's the standard, the standard market premium, kind of across a broader, broad range of public acquisitions. So figure out how much we want to pay. Then we put together our sources and uses. Okay.
Yeah.
Sources. Where is the money coming from? Equity, debt, maybe some balance sheet cash. That's basically the three areas where we can get money. Where is the money going? The enterprise value of the business, or if we want to break down the equity value of the business and the outstanding debt of the business, right? Or the
Yep.
outstanding net debt of the business if we want to use the cash. So we build out our sources and uses. Then very, very similar to a DCF, we build out our model. Okay. We make assumptions. We make assumptions around the revenue growth. We make assumptions around the COGS. We make assumptions around the margins. And then we basically, instead of getting unlevered free cash flows as we do with the DCF, we get levered free cash flows because it's an LBO and we care about interest expense in LBO in order to determine the equity value that we're able to take out of the business, or in order to determine how much cash is left to service the rest of the debt. So build out our assumptions, do our levered free cash flow. We basically figure out how much debt we can pay down over time, and then we make an exit assumption. And what's that exit assumption going to be? Usually, whatever my entry multiple is also my exit multiple. Generally, it doesn't have to be. Maybe my exit multiple is lower because I think I'm slightly overpaying for the business and I want to be conservative. Maybe my exit multiple is higher because I think I can get a screaming deal on this business because it's just been poorly performing and has a horrible management team. And I know that from a market perspective, it's worth here, but what I can get this for from a value perspective is here. So therefore I can increase the multiple upon exit, whatever, right? But then we assume that exit value. And now we have our enterprise value, subtract out our net debt as we went through with your, enterprise value to equity value bridge. We have our equity out, we have our equity in, we put that into our IRR formula. What's our return? 22.5%. Sweet. Looks like we can pay this price for the business. Let's go ahead and make an offer. The other thing that we also get when we do that calculation is we do something called MOIC or MOM, money on invested capital, money on money. So how much equity did I put in? How much equity did I get out? Divide the two, right? So I put in 100 of equity, I got out 300 of equity, 3x.